The June 30th reports are behind us, and overnight the market told us exactly where its head is now. Soybeans firming on the back of demand, wheat bouncing off of a 4-month low, and heat building across the Midwest right into a corn crop that's trying to pollinate. We are officially into a weather market. But here's the thing I want you to hold on to for the next 10 minutes. For your operation, whether you farm a few hundred acres of row crop, a few thousand, or run an elevator, the question was never which way is the market going to go? Nobody knows that. The real question is my written marketing plan ready for this weather market and for the July 10th WASDE? That's what we're going to be working through today. I'm Dan Hussey, Senior Market Strategist with Zaner Ag Hedge. Quick note before we start, this is educational and advisory. When I give an opinion, I'll tell you it's an opinion, and there is real risk of loss in trading futures and options, so let's get into it. Here's the plan. We'll go through 3 pieces of market context, and I'm not going to leave them as trivial. I'm going to tie each one into a decision that can actually be made this week. Then 1 framework to pressure test your marketing plan. Then a straight talk on risk and where the early wire fits in if you want that type of pre-open picture every morning. 3 contexts, 1 framework, and an honest risk conversation. So let's start with demand. Context 1. Demand is doing the heavy lifting right now in 2 crops. Start with corn. Grain stocks report showed June 1st corn stocks at 5.295 billion bushels. That's up 14% from a year ago. On the surface, plenty of corn, but it came in about 113 million bushels below what the trade expected. And the reason is demand. The March through May disappearance was a record for that quarter, roughly 3.73 billion bushels. So the crowd went in looking for loose old crop stocks and got tighter numbers than they were bargaining for. Then look at soybeans. New crop November beans have firmed towards 1155, 1156 this week, and that's not a weather story. That's a demand story. Record large crush penciled in for the new marketing year. Strong soybean oil and biodiesel demand tied to higher federal renewable volume mandates and a shift in that bean oil share in the crush, plus some spillover strength from energy markets, which arguably are starting to ease a little bit and might be tied into some of the weakness we've seen pressuring soybeans relative to corn and beans or corn and wheat this week alone. Here's your decision. Storage and pricing with a purpose. On corn, on farm stocks are still up about 16% year over year. So a lot of you are still sitting on old crop. Are you holding those bushels against a written target, a real plan, a price, a date, a basis level? Or are you holding them by default because you just haven't sold yet? And on new crop beans, if this demand picture is real, where does that price put your plan? My opinion, and it's just an opinion, a demand picture this firm is reasonable basis for a disciplined selling plan, especially into the strength, rather than an open-ended hold. But here, the other side, holding unpriced grain, is in itself a position. Carry costs and price risk run against you if the market eases, and demand-driven rallies can reverse as fast as they came. There's real risk of loss in staying unpriced and real risk of loss in tools that you'd use to price them. That's exactly why we write this down instead of winging it. Context 2. You've got more corn acres, but the crop still has to be made. The Acreage report put corn at 95.3 million acres, down 3% on the year, but above what the trade expected. A heavier supply backdrop on paper, except paper isn't a crop. Conditions have been slipping. Last print was 67 good to excellent ratio on corn, 65% on beans. And now we've got a real July heat rally landing right on top of pollination, the highest leverage window of the whole season. Some forecasters think the ratings come down a few points from here. Others see a relief by mid-month and a cooler, wetter pattern entering into the Midwest. I'm not going to stand here and tell you I know which one wins. It's genuinely two-sided, but that's the fun part of having a marketing plan that can take care of either direction for you. New crop corn is trading around 44 cents a bushel, or $4.44, bounced about 17 cents off its late June low, but still down roughly 39 cents on the month. November beans, like I said, near 11.56 and closing the day here at 11.47 off of that high. Here's your decision. What are you, or where are you right now versus your written plan on new crop corn and new crop beans? Let me frame it in both directions because that's the honest way. If weather threatens and rallies development, or if weather threatens and rallies develop in price, the bushels you priced in advance let you sell into that strength on your terms instead of chasing. But if the crop makes and prices ease, those same incremental early sales mean you're not sitting there 100% 100% unpriced watching it go. Neither of those is a forecast. It's coverage for both roads. And the risk, plainly, every pricing tool, futures, hedge to arrive contracts, options, they all carry marginal risk, basis risk, and opportunity costs. There's no free option here. Pair every upside thought with that reality. Our third context, number 3, wheat and the report on the calendar. Wheat is wheat is the remainder this week, or the reminder this week that markets cut both ways. It set a 4-month low on Monday, then bounced for 2 sessions with new crop Chicago wheat back around 606, failing to close at 599 and 3/4 on the week. Little worrisome, but still, KC wheat uh, around 638 at its highs. I think we went out the wheat week here at around 638 and a half. And remaining a little bit stronger. And that's what with harvest running well ahead of the average pace, which normally leans on price, down hard, then up in the span of a few days. Then there's the July 10th, the WASDE, the USDA's first new crop balance sheet built on acreage numbers we just got. That's going to be a real catalyst for change. Here's your decision. Don't let a report catch you without a posture. Decide now before the 10th how much of your bushels are priced and whether the unpriced ones have a defined risk floor underneath them going in. My opinion, a known and written posture ahead of a catalyst beats reacting after the number hits and the market's already moved. But the risk cuts both ways, and I want to be clear. Reports can move this market sharply in either direction. There is no safe side and no guaranteed outcome. A written posture doesn't remove the risk. It means you decided with purpose, on purpose, instead of being reflexive and reactive. So let's turn that all into something you can do. I call it the 4-question pressure test. Grab a pen, pause the video if you want. Question 1, coverage. What percent of old crop and your new crop is actually priced versus the targeted range in your plan? A real number, not a feeling, not a gut, not an inkling, not what you think dad said, not what you think grandpa said, not what the almanac says. What did you write down as a number that you wanted to price at some point in time? If you haven't looked at it, I suggest you do. Question 2, triggers. Do you have both price triggers and date triggers written down? Not, I'll sell it if it rallies. An actual price, an actual decision date. The July 10th WASDE is a natural one. Question 3, protection. For the bushels you're leaving unpriced into this weather market, do you have a defined risk floor or reownership tool in mind? And do you understand what it costs and what it costs of those risks? A floor isn't free and it isn't magical, but it is something you need to think about. It's the insurance you can afford and everybody needs. It's the stuff you don't want to have until you need it. Question 4, cash flows and margin. If you're hedging, can the operation handle marginal moves or basis swings without it becoming a problem? Elevators and co-ops, is your basis and your carry aligned with all of this? If you can't answer all 4 clearly, that's not a failure. That's just this week's work. And do it with your advisor, built around an operation. This is the process and discipline. This is not a one-size-fits-all signal. And anyone selling you one of those isn't selling you something. Let me land this plane. There is a two-sided market right now. There is real risk of loss in futures and options, and they're not suitable for everybody. Nothing I said today is guaranteed, and nothing and is not a recommendation to buy or sell any specific contract at prices. It's a framework to work through with someone who knows your operation. If you want to work through these decisions with better information, that's what the Zaner Early Wire is for. It's a pre-open context, and the overnight moves, the day's reports, the levels people are watching in your inbox before the bell rings every morning, so you and your advisor aren't starting from scratch each morning. Sign up in the links in the description below at zaneraghedge.com/ZEW. Sign up if you want to go there directly. And if you want a one-on-one look at your written plan ahead of July 10th, reach out directly to me, dhussey@zaner.com, or call me at 312-801-4231. I'm Dan Hussey with Zaner Ag Hedge. Write down a plan, work it out with your advisor, and I'll see you on the next one. There is substantial risk of loss in trading futures and options, and they're not suitable for all investors. Past performance is not necessarily indicative of future results. Have a happy 4th of July, everybody. God bless America and for another 250 years.